Hello, I'm TaxLawPaul. I'm a lawyer and CPA with 40 years of experience as a tax accountant and a tax lawyer. One thing I like doing or just as much as preparing taxes, that's estate planning. And the way we do estate plans is from more of an accountant, starts with an accountant's perspective. Now in Oklahoma, probate is very expensive. Therefore, there's a lot of revocable trust. And when you start having sufficient assets, you really should have a revocable trust to reduce the probabilities of problems. Now, the way we start it is we develop a balance sheet from an estate planning perspective. Our balance sheet, here's column 1, has the assets of the clients. This is a married couple, and we have their bank accounts. They have 4 or 5 bank accounts and financial accounts. They have 2 private businesses. John has his, Jane has hers. Then they have a personal residence. That is in Jane's name. They do have 2 pension plans, life insurance, a couple of automobiles, and some personal property. In particular, Jane has a pretty nice art collection. Other people have gun collections, etc. Then what we have is here is John's assets in one column. Here are Jane's assets in one column. And then we have the total assets of the joint couple. And what we do here is column 5 is we have the testamentary disposition. Testamentary means how do they pass when John or Jane pass away? Well, John and Jane, they have determined most of their assets are going to pass pursuant to their revocable trust that we put together. Now, in John and Jane's situation, each spouse will own their assets in column A and column B. Now, it's revocable because they can take these assets out of their trust, out of their joint trust, that is their assets, and do something else with it other than this trust, except when one of them dies. It becomes irrevocable. Now, what we then have is they're in a situation where they have adult children, they're all in their 40s, and they're responsible. So everything goes to the surviving spouse. Then after the surviving spouse passes away, everything goes to their children per stirpes. They have 3 children, 1/3 apiece. This is a fairly common estate plan. It makes it easy. Then in column 6, this is the notes, the checklist, and the transfer instruments and the due diligence. This is our checklist that tells us what to do. The revocable trust has been prepared, but now after it's prepared, you have to go to the bank and put the assets into the revocable trust, title it in the revocable trust. And so this is the checklist where they check it off after they do every one of them. Now, in this situation, they have 1 grandchild, and that's Janet Doe. Well, grandmother has a $15,000 account, and she wants, when she passes away, she wants that $15,000 to go straight to her granddaughter. Her granddaughter, at the time we put this together, about 10 or 12, she's just thinking, well, if I passed away soon, I kind of want Janet to have a car independent of Mom, if that's what she so desires. So what we do here is we have a pay on death account for Janet Doe if she survives Jane. And that's one thing you do in estate plans. Don't make the assumption that the 10-year-old is going to outlive the 70-year-old. Most likely that's going to happen, but it's if she survives Jane. Now, then what we have is John's business is the biggest asset, and that's going to go to the revocable trust, and we're making sure that Jane or another trusted individual can sign on his checking account. If John passes away, there's money coming in, money going out. Somebody needs to be signing on that account, and you need to get that person on that account now. Now, what we're having is in 30 days, John and I discussed what he's going to do. Well, he doesn't quite have a plan, but what he's thinking is that it's fairly marketable business, and he is going to start talking to business brokers about listing it, and what does he need to do to sell his business. He's not there yet. He likes it. It's what he does. Now, then Jane has rental properties, nice commercial rental properties. Well, she's not real concerned about how to transfer those because they're highly marketable. She believes that the children will figure out how to, they'll either operate the 4 or 5 buildings or they'll sell it, or a combination of both. They're, like I said, they're 40-year-old kids, they're responsible adults. They're going to get along and figure out what to do with mom's assets. And then there's the rental account, and we're verifying that the rental account is in the LLC, Jane's Rental LLC. We're making sure that these homes are all titled in the LLC or their commercial real estate, and making sure they're titled in the LLC. And then we have the personal residence. Well, Jane owned this residence right when they got married as a young lady, as a young couple. And so what we're going to do is we're going to prepare a deed and we're going to transfer her home to the revocable trust pursuant to a quitclaim deed. Now then they have pension plans. They don't have a lot of money in pension plans, but Jane, she does. She's had a nice job in addition to her rentals. Now what we're going to make sure, we're going to verify with the custodian that everything in that account is John's goes to Jane upon John's passing, and then per stirpes to their children. Another one, same issue with Jane. She has a bigger bank account or a bigger pension plan. Well, we're going to verify that this to John and then to the Jane Doe children. I have seen situations where a large pension plan started before a couple has been married, and the spouse was very certain everything was to their spouse and then to their kids. Well, once they double checked, that was his second pension plan that did not have near the money in it that he was thinking was titled correctly. So he just went in there, did a new beneficiary designation and corrected. He verified. Now we go to the life insurance. Jane has a small policy at work. What she wants to do is all to John right now and then to her children per stirpes. Jane is thinking about, well, we probably have enough money that she's going, I think I might change that just directly to the kids. And John's perfectly fine with it. They have an estate pushing $5 million. Now then we have the automobiles. All right, they have nice automobiles. Well, make sure to go down to the Department of Motor Vehicles and title it in the revocable trust. Now, John's automobile, he didn't know whether his corporation or his LLC owned it or not. I said, okay, let's verify that. Now, if it owns it, make sure that it's in the trust or in his LLC, and and make sure it's in the business. And then the business passes pursuant to the revocable trust. Now, then they have their personal property. Well, they've got their basic furniture, and I'm going to prepare a general assignment and a bill of sale to go to the revocable trust, and it's going to get transferred to the kids. They're going to divide it up equally. And then what we have is Jane's art collection. Her art collection, she says it's worth at least $50,000. So I put $50,000 down. And what she has done is she's got about 25 pieces, and 8 or 10 of them are really nice. Well, she has 8 or 10 pieces that she has designated on a piece of paper which child gets what. Some of the children, oh, Mom, I really like that one. She knows who likes what. And then they'll figure out what to do with the other 10, 15 pieces amongst the kids. And then we list their mortgages or their debts. Well, they have an automobile debt. Well, it's not big enough to be relevant in this trust. It could be, but it's not. And so that is how we put this together. To recap, list the assets. We go through like an accountant, making sure everything is listed and they know what they want to do with it. Who owns it? Remember, if John wants to revoke this trust, he can do it with respect to his half. Jane can do it with respect to his part. Here is the total. Here is how the instrument is going to be used to pass it to their children. Here is the checklist of what needs to be done, and it guides us. For example, I know I have to prepare a quitclaim deed. I've got to prepare a general assignment, and then Jane and John, they go down to the bank and to the DMV, and we just check that list off. And what I'll do is pester clients for a couple of months to make sure they get this done. Most of them get it done, and they will tell me, yes, I've got it done. Or some of them don't get it done, and after a couple of months, they'll say, well, all right, if they don't want their automobile in the trust, I'm not going to go any further with it. And that's how we do it. And then once we're done, it's all in a booklet, in PDF and hard copy form. And in this booklet, we have this balance sheet. And we also date this balance sheet. And what is good about that, when the heirs come along, they know, well, at least at this date, this was mom and dad's or grandma's assets. And that's where they start. So they're not asking, well, I know mom and dad have a few bank accounts. Well, they do, right here. And, oh, the life insurance. Oh, I need to call mom's employer and find out about the life insurance. And that's how this works. If you're interested in us helping you with your estate plan, starting from an accountant's perspective, give us a call. Paul H. Burgess and Company, area code 918-901-9000, or see us on the web, paulhburgess.com. My assistants will answer the phones, they will tell me who's called, and we will set up an appointment and get you started. Thank you very much.